everybody, and welcome to another episode of the Eitel Insights podcast. My name is Dane Eitel, and I am the founder and lead analyst for Eitel Insights. Today we're going to be going over the Greater Vancouver Detached market. Prices are down and sales are way down, folks. Don't believe some of the misleading headlines that say just because May's sales beat April sales that the market is turning a corner. It's really not. The horizon looks quite ominous, folks. And first of all, before we get into all of the content distribution today, I really wanted to say thank you to the followers and to the subscriberships. The subscribership has gone up, the thumbs have gone up, and the views have gone up. So I really do appreciate everybody sharing it with your platforms, with your friends, with your families. And I'll ask you to continue to do that as we get to share this message with more people. It's benefited everybody so far who has listened, and we'll get into that here as well. So without further ado, let's toss up our first chart of the day. And of course, as always, it is the detached market chart. So if it's one of your first times following along, we do use technical indicators throughout all of our charting here. Really why technical indicators is an interesting thing. It really takes emotion out of the game completely. It shows you trends that are prevalent, trends that have been broken, and where the market momentum is headed next. That's why we were able to call the market in 2017, saying the market had peaked after seeing a triple top. And we were the first unequivocally to call the top of the market. Not only did we call the top of the market in 2017, but we also forecasted the bottom occurring in 2021. Which might sound a little bit familiar for folks that, and pretty much everybody has heard, CMHC has turned negative for the first time in a long time. Again, we're just going to remind you of what Eitel Insights has said in years previous to what CMHC just said this last month. In 2017, again, Eitel Insights called the top and said 1,400,000 would be the likely bottom in 2021. That was in 2017, published in the Western Investor. And of course, with our podcast and our articles that had been featured later. And in 2018, we said, hey, listen, if 1.40 million does not hold as a market bottom, then the possibility of an overcorrection is there, and that possibility would land the market at a 31% correction, leaving the market around 1,225,000. So the 1,400,000 price reduction from the peak is a 23% correction. The overcorrection down to 1.225 would be a 31% correction. Now we'll get back to CMHC, which they just updated last month. So based on the April sales data, which is what they were basing it on, they called for between a 9 and an 18% drop. What's 9% off of 1,600,000? Leaves you with a sales price of 1,450,000. A little bit rosier than Eitel Insights and way late to the game. Their outlier of 18% leaves the market at 1,300,000. Again, $75,000 north of Eitel Insights prediction in 2018. So really, folks, we are becoming the industry leader. CIBC followed suit, I believe, in April, saying that the market would be down until 2021. And so, we were the first to the party. The party was empty for a long time. We were correct all by ourselves. But now it's nice to see some other folks joining the party. We do appreciate that. It's always fun to have some fun to hang out with knowledgeable people that have finally caught up to what we've been saying for a while. One of the reasons for that, again, we use technical indicators, and here's a saying that we've kind of become known for. Technical indicators know what fundamentals eventually learn. Okay, now what we mean by that is technical indicators alert you to a change in a market momentum long before the change has a name. So we called the top in 2017. There was stress tests. Before that, we noticed that there was an initial peak that did break the uptrend, the very sharp uptrend that we don't even have on the chart because it was from 2015 right until 2016, basically a perpendicular line that did break at January 2016 and February 2016 with an average sale price of 1,815,000. That was your first peak of the top. And again, we did confirm that with a triple top by 2018. And of course, subsequently, prices have gone lower. They have gone so low as $1,480,000 in February of 2019. What was interesting about that and was kind of mischaracterized by a majority of the analysts was that was the bottom. And prices would be going back up north with not too much of a problem. What was missed completely was all that was stress test mitigation. That was 20% off of the previous high prices. So when the government came in 2018 and said, hey, we don't trust you with your own money, we don't want you purchasing at your maximum capacity anymore, so we're going to dock you 20%. That literally forced the prices to come down 20% to equal out what they used to be able to afford at 100%. That was epitomized at $1,480,000. So there was legitimately pent-up demand. And Eitel Insights had alerted you to that when the prices were down. They're saying, hey, listen, this is the 20% stress test. You will start to see purchasing occur. Our article with Money Talk said the buyers are off the sidelines for the first time in years. It all came to fruition. You could sell into that period of strength. Was it the bottom? No. No way, no possibility. Why can we be so firm on that? Well, just like every other market cycle that has existed in Greater Vancouver, and usually every other chart that exists with market cycles, there is a cluster of prices that on the way up are challenged in a fairly tight band, which is 2015 prices. You see that right around 1,400,000 to up to 1,408,000. That's your band, okay? That's the prices that this market has to test before it can go higher. So of course we did advise you to say, hey, take advantage of this stress test mitigation if you can as a seller, but as a purchaser, we said prices would be going lower longer. And of course that has proven up correct. I mean, unequivocally correct. However, there seems to be some argument about that. So let's just kind of take this here on a year by year average of the entire year sale prices of Greater Vancouver. So in 2016, the average sale price was $1,700,000. In 2017, the peak year, sale prices were at $1,715,000 for the year of 2017. In 2018, average sale prices were $1,680,000, so we begin to go lower. 2019, sale prices were $1,565,000, much lower. And here so far in 2020, we're sitting at $1,617,000. So we're a little bit above 2019. However, we're kind of in the middle course of the year where times are supposed to be pretty good. I mean, seasonally, you're in your spring, summer market, right? So sales are taking place, tours are happening, open houses are transpiring. There's a hum in the market. The market's very quiet right now, folks. And you know, we heard, we saw the headlines of a multiple offer, got 16, 12 offers, whatever it was. Great, cool. And then realtors say, well, that wasn't the only one. There was another one. I heard Johnny over here got multiple offers. Cool. There should be multiple offers when you list at a lower than market price. When you're attractive in your pricing, yes, you do get activity. That's something we've been prescribing for a long time. That the new normal will be lower prices. So if you've listened and adhered, yeah, you can get some multiple offers on your property. Is it worth what it was worth during 2018, 2017, 2016? Unequivocally, no. So, you know, for our listeners out there that, you know, are you know, interested in the market and hearing from their realtors that sales are up, we're going to get into that and we'll completely kibosh that talk. And that sale prices are near highs. No, but they were, right? And that's exactly why you need an analyst, not necessarily a realtor for market opinions. Realtors work with clients, they speak with other realtors, they talk in their offices, but that's not the entirety of a market. Eitel Insights says, you know, hey, March, sale prices were at $1,700,000, near the upper echelon of this market cycle. It's over. You know what I mean? Like the uptrend's here, we're up to all-time highs, sell out, sell out, sell out because something bad's going to happen. Lo and behold, coronavirus hit this market. I mean, technical indicators are a thing. Until you test the bottom, you cannot be finished with a market cycle. So 1.4 will need to be tested. If it cannot hold, 1.225 should be the overcorrection number that finds a base and then market starts to go back up. One interesting thing, you know, I mean, everyone's really pushing their 10-year outlook because realtors all of a sudden are writing op-eds, opinion eds, and it's really interesting how they're calling market bottoms when 2 months ago the market was already soaring. You know, the rollout effects of this negative economic situation are still continuing to transpire. By no means is this over, right? Just because you deferred your mortgage payment, you kick the can down the road. You still have mortgage payments coming up, and if you're in the first 5-6 years of a mortgage payment or a mortgage qualification and payment of the house, literally before the first 7 years, you're paying off mostly only interest. So you have no equity paid off of your property, although the equity in the property in 2021 will be worth $430,000 less. So, there's nothing positive. And again, so let's get back to the 10-year. To have a 10-year outlook is fine, but you need a 5-year outlook, a 2-year outlook, and a 1-year outlook for that 10-year outlook to be absolutely effective. To just buy and put your head in the sand in 2016, your 10-year outlook is pretty much a little bit up, right? So in 2016, from 5 years out, 2021, you'll have lost $430,000. We're kind of predicting around 2024 prices come back up to the old all-time high. So that means that you're in it for 8 years and you're at zero equity. If you purchase at the peaks, it's going to take you 8 years for your property value to come back up to par, to neutral, to zero equity. So you're at a loss, and we're praying to God for a zero. That's not the place that Eitel Insights investors, clients like to be. So where we would like to say, and what we have said publicly, privately, all over the place, please don't be buying into this market. So far to date, since we've said it publicly, unequivocally written in print, the market has come off $245,000. Okay, on its worst at $480,000, it was much worse, and of course by 1.4 it'll be a total of $430,000. But just hard facts to date, $245,000 has been saved by adhering to Eitel Insights purchasing advice. And it takes a long time to accrue that much wealth to put into a property. We've basically minimized that by letting the property values come off and you taking advice from our analytical interpretation, offering you actionable intelligence. And so just as we're on that, of course, we do offer our individual reports for $250. So if you got a report a few years ago, we did forecast right up until the market bottom of that particular market, whether it be Coquitlam, North Vancouver, New Westminster, you know exactly what's going on in your local market, the same way everybody that listens to our public comments about the overall market knows. So for $250 so far, if you order the Greater Vancouver report, we give you extra details such as our proprietary supply-demand study, along with a relative strength index study and a few others. And we've saved you $245,000. So it's really not even a major percentage point of the savings that we've offered you. And of course, we do have a higher level of reporting for different types of investors. We do have monthly reports that are starting to go off like hotcakes, especially as we are starting to get closer to the bottom in some of the areas that make up the Greater Vancouver. So there are 20 sub areas that make up Greater Vancouver. Here we're talking about all 20 in an aggregate, basically. Your 10-year outlook needs a more finite year outlook, and we can have a 10-year outlook in 2021, no problem, because we're actually expecting prices to go up from that point of view. And then maybe if you wanted to have a 20-year outlook, sure, no problem. You already had equity built up in the property. You can live through the next market recession, the next market cycle, the next market bubble, if you really want to get cataclysmic with it, which was one of the questions on the last podcast. Do you see another market bubble happening? Absolutely. I mean, you can call it a bubble. I call it a market cycle. There will, after we're done with this market bottom, there will be an uptrend that establishes itself back up to the old all-time highs of 1,830,000. Once we test that and break through it, we will go to the next echelon, the next stratosphere of a market cycle, which will obviously be higher than 1.830. Will that be too high at some point in time and another market cycle will occur, another downtrend will occur? Absolutely. That's just historical. That's just markets. That's cycles. That's exactly what we epitomize and what we identify where we are in that market cycle. Here, we're closer to the end, but we're still very much going lower until we do find that bottom. So now let's get into one of the interesting stories of the month, which was sales. You heard a lot about sales, how great they were. So there was, and they weren't great, okay? They were better. They were not great. So the sales at land titles, which of course for our followers know, are accepted offers from previous months. So it's not exactly the best indicator for what actually took place in May. It's from previous months. But May sales at land titles were 544. Which were undoubtedly better than the 392 that took place in April. No question. I'll concede that. And we'll even concede that the more accurate number of accepted offers, which was 525 in May of 2020, this past month, was better than 369 that took place in April. Unequivocally better. However, now let's deal with apples and apples. So May accepted offers over the previous 5 years. Basically, this epitomizes what we've been saying. We've been saying that the uptrend in prices has been broken, and the market would start to be more negative. That would take place with lower sales and lower sale prices, and eventually increased inventory out of a need basis, not out of a want basis because you're selling it at a high price. It's because you need to sell it. So we'll get into the May accepted offers over the previous 5 years. In 2015, when the market was still heating up and in an exponential uptrend, there was 1,837 sales in the month of May. In 2016, there was 1,820. Again, frenzied mentality. 2017, 1,503. So it peaked, right? It's starting to come lower. Then in 2018, 871. All right, we're quite a bit lower. And then May of 2019, 839. We're literally 1,000 lower than we were in the previous 3 years. And now we're at 525. Show me how that's a positive number, okay? And we are dealing with the coronavirus and economic downfall trickle effect, right? Like, this isn't over. So just because you got back to work doesn't mean that your shop's doing necessarily very well. It's a struggle right now. People are trying very hard, but this will have a negative impact on the market. With the renters that are getting some help from the government, that will eventually end. If you can't pay your rent, you got to move out. If you can't pay your mortgage, the bank's going to foreclose upon you. These are harsh realities, but these are in the pipeline, right? So this is what we're saying that you can take advantage of as a buyer. As a seller, we hope you took advantage of our advice previous, right? Because there's really nothing positive coming up as we enter into this lowest phase of the market cycle. You had since 2017 to listen to us, to sell. Now we're really speaking to the buyers. Okay, the sellers should have sold, and now it's starting to take advantage of some of these sellers that are going to be upcoming, that are going to be selling at, of course, lower prices, which is to the buyer's favor. And one other thing that we'll just point out here about this sales chart. In 2015 to 17, you see these abnormally high volume of sales, right? That's because the sellers were choosing to accept these prices, right? Like they were getting all these wonderful pie in the sky prices. Of course they're going to get sales, but with these low sales, the seller is still asking for too much money. And this will continue until you actually see this market bottom and start to come back up. It is kind of that mass mentality. You don't really want to be where the herd is all the time with investment. So while everybody was purchasing, you probably should have been on the sidelines. When nobody's buying in 2021 and all this news comes out about the foreclosures and how much this seller lost over 5 years and this and that, and people are scared to put money to work, that's when we have to step in, okay? When there's desertion is when we want to be buying. When it's frenzied, we want to be selling. And that will continue to show itself up here as the market continues to progress. One last chart before we get out of here is the inventory chart. And that one's an interesting one, okay? So we have very low inventory. Considering the over all of the last 15 years, we're way below that. We're roughly, I believe, at 5,800 is the average inventory over the previous 15 years. We're sitting below 4,200. And 4,200 seems to be an artificial ceiling that's in this marketplace right now. And we've drawn that black line at that. There is an uptrend with this green line that will propel this market beyond 4,200, probably up to 4,500, 5,000 and beyond. You have these hard numbers at even numbers that are technically important. And again, what's interesting, you see this peak in the sales activity during 2018, right? Where the sales the inventory was right around 7,000. That wasn't out of need-based selling. That was, again, out of some buyer saying, I'm going to give you an exorbitant amount of money, more money than you've ever been offered in your life before for a property. And tell you what, I just beat 5 guys that offered at the same time as me. It's literally the most money you could have had. They took it. And that's why you saw high inventory during those years was, hey, listen, we can achieve the highest sale price possible. Take advantage of it. What you will see with this next echelon of high inventory is need-based selling. It's the bank saying, sell it or we will, or it's you got to sell the house to keep the business afloat for a while. Not ideal situations, but reality nonetheless. And that's something that a buyer can take advantage of in this upcoming future. But patience is a virtue, and timing is absolutely everything. No longer do we need a 10-year outlook. We'll give you exact price points and exact years and months inside of a year to look forward to return to the market, especially in the independent areas once you become an Eitel Insights client. Thank you for your time today. We really appreciate you guys listening. Hope you did appreciate the content. If you did, we would ask you to give us a thumbs up, and feel free again to share this content with your platform, with your friends, with your families. Thank you very much. Talk to you soon.